Hey, good morning once again, options traders. Well, I'm hearing a lot more talk about positive theta because during February of 2022, we are experiencing a lot of volatility. Now we're seeing headlines about Russia potentially moving into the Ukraine, and we start seeing this pump up the option premiums. And the problem is that option traders hear about this wonderful property of positive theta. The idea that they can sell options and collect this premium. And yes, it does seem like it might be for free because we know that at expiration, all of that extrinsic value goes to zero and they say, I'll just sell these options and collect these premiums. And what could be better because I don't even need to buy the option back at expiration? Well, there are some good characteristics of positive theta, but as I always remind traders, there is also a cost. And you shouldn't enter into any trade until you also understand the costs. So what is the cost of positive theta and how can it come back to bite you? Well, first recall what theta is. It's one of our Greek measures. And I've got lots of videos in here on the Greeks, and they're just outputs from pricing models, but they tell us certain characteristics about how our option prices are going to change. And one exception is gamma, where it talks about how our delta is going to change. But remember that theta isn't a true risk. A lot of people think it is, even though it's one of the Greeks. It's not really a true risk. And the reason is that we know that time moves in one direction at the same speed. We know that all option extrinsic value comes out at expiration, so there's nothing that is uncertain. If you have an option today that has $5 of extrinsic value and it expires in 30 days, I can tell you with 100% certainty that that $5 extrinsic value will be zero. So if it's something that is 100% known, pretty hard to call it a risk. So with that little bit aside, just remember that theta shows the rate of an option's decay. So if you buy an option, you have negative theta. It's wilting away over time. But if you sell that option, you have positive theta. The losses to the option buyer are going to the option seller. So as an example, let's say that we are looking at a $100 call trading for 5, and your broker's platform shows that it has a theta of minus 0.10. Now on your broker's platforms, theta will be shown as a negative number because it's assuming it's a long option. So in this example, it just means that if you bought the $100 call at this very moment, it's experiencing a theta of minus 0.10. And what that's telling you is that tomorrow, one day later, we would expect this option to be trading for 10 cents less, or about $4.90. Now it's important to remember this is all things being equal. Stock price is the same, the volatility is the same, interest rates, everything is the same. But if those factors are in fact the same, we would expect this option to be trading for $4.90. All right, well that's great, and we can certainly look at this and use this to our advantage in some cases, but the bigger question that we must answer is what's the cost? So as I just talked about, remember, there is always a cost. So yes, positive theta is a benefit, all things being equal, but negative gamma is a cost, and negative vega is a cost. Gamma and vega are always on the opposite side of theta. If you have negative theta when you buy an option, you've got positive gamma and positive vega. If you sell an option so that you get positive theta, now you've got the opposite. You've got negative gamma and negative vega. Now this idea of the gamma and vega being on the opposite side is true, assuming that all options share the same expiration. And this is where option strategies become even more fascinating because we can actually flip these relationships by using different expirations. But if we have the same expiration, you will see that gamma and vega are always on the opposite side of theta. So let's see what happens and why this can be a cost. Let's say that we buy 100 shares of stock and we sell a $100 call against it. Well, this is just our typical covered call. This is what our risk graph looks like at expiration. But today, let's say with 30 days to go, our risk graph looks like this. And so notice that we have curvature here. This curvature is gamma. And the fact that it's curving downwards, facing down this way, is that it shows that as the stock price rises, that we are starting to reduce our deltas. Notice that we are going from a positive delta down here, close to +1 down here, and then we're slowly moving towards delta 0 up here. That's why the orange line is getting flat, and the blue line for that matter. Everything to the right here is flattening out. We are effectively selling off shares in a rising market. Well, that might not be a risk in the sense of a loss, but it's an opportunity cost and usually something that traders would rather not experience. You'd hate to see this $100 stock go to $300 or $400 and find out that you sold off all of those shares mathematically. But that's what happens with negative gamma. Now, what about to the downside? Well, the opposite happens. Notice that we're starting to go from 0 up on this end down towards +1. We're looking like long shares of stock. So with negative gamma, we are effectively buying shares of stock if the stock price falls. So you can see that if the stock price falls from up here down in this direction, look what's happening. We're starting to ride down this portion of the curve. We are buying more shares into a falling market. Depending on your strategy and your outlook, that might be a good thing. Again, it's never about right and wrong. It's about how are you using these tools and what are you trying to do. Now the positive theta comes in. Let's say over time, this orange line might be 30 days till expiration. 10 days later, we're going to move from the orange to this gray line. We're starting to move towards this blue, and that's because this option is starting to lose some extrinsic value. And then with 10 days to go, might look like this. 5 days to go, look like this. And then right at expiration, we fall on this darker blue line right here, this thicker line. That's why it's called the expiration graph. So yes, we can see that this position is becoming more profitable over time. That's why these lines are moving higher in the graph. We're moving from the orange to the gray to this yellow to this blue. It is appreciating over time, even though the stock price is sitting still. So yes, that's a benefit, but that is assuming that the stock in fact stays still. If the stock rises, again, you're going to be selling off your deltas, heading towards 0. And again, that's not necessarily a risk, but it is an area of regret. It's an opportunity that you're missing, but the real risk is down here. If the stock price falls, you are actually accelerating those losses. And you need to understand that because in a volatile market, if this stock really takes a nosedive, you're on a +1 delta way down here, and you can experience very large losses. Now, what about the negative Vega? Well, we're just going to work these curves in reverse. All things being equal, we'd rather see that this curve is getting closer to the darker blue line, the thicker one, because it shows that we're getting closer to expiration and that we're correct that the stock has in fact stayed still. But if volatility starts to rise, not only are you at risk of having the stock price fall down here, but these lines are going to start working in the opposite direction. They're going to start moving out this way. It's going to become harder, or you have to wait longer to get your profit from it, just because the volatility is pushing the line back out in this direction. So if you sold the option with a volatility, let's say down here on the yellow, and you think that the stock is going to sit still, but volatility rises, now you start moving out in this direction. You're getting worse. And you're also having a much higher chance that the stock could fall down here, pushing you into large losses. And you've also got a large chance that the stock could be coming up here, giving you a very big regret. So the main thing to remember is that all strategies have trade-offs. And I think this is probably the big thing that I find that most inexperienced traders either don't understand or just seem to ignore. There is always a trade-off. So it's not enough to know what you're expecting from the stock or from volatility or from interest rates or whatever your outlook is. You can't just say, oh, I think the stock is going up, let me buy a call. Or I think it's going to sit still, let me sell some options. It's not enough just to have an outlook. You must also understand the trade-offs and what could happen if things go wrong. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.